In this video, we're going to talk about the cost of equity, and so what equity is, and how we figure out how to value equity, or why the value of our equity is what it is. And so we'll just start by talking a little bit about what equity is. So equity is, when you hear people say they're a shareholder in a company, that means they own equity in it. Equity is the money that people contribute or build in a project that is not required to be paid back. So if you're an investor and you give somebody money and say, I want to pay that, you need to pay me that money back in the future, some explicit statement of how much and when, then that's debt. But if instead they give it to you and say, no, I'm just going to invest in your company, in return for that, if you do well, I get a percentage of whatever you do well, that is equity. And so instead of receiving some firm commitment, they receive a share in the business. Now, you might ask, why would somebody want to do that? Well, the simple answer is this. If you're an investor and you think a company is going to do very well, then you want the opportunity to earn more and more profit as the company earns more and more profit. And the only sort of standard way of doing that is to be an equity participant. Remember that as a debt participant, you put your money in, you're entitled to a specific payment whenever there is a payment due, but you're never entitled to more than that. And so if the company does very well, you don't get to participate in that. So this is the common arrangement for when we say, look, I want to own shares in your company, I want to participate as an equity investor. That's what we mean. And so the way that works is that in years when the business does decide to distribute money, and I say decides to because they actually have to decide. It's not just that they have money, and if they have it, they have to distribute it. They can hold that money for a lot of reasons. They use it for investments and so forth. But when they decide to distribute money, then you get your share of whatever the total is they're going to distribute. And so, for example, if they decide that they're going to distribute $5 million in a year, and there are 1 million shareholders, then, or 1 million shares of stock outstanding, then each stock is entitled to $5. So say you own 100 shares of the stock, you're entitled to $500 of that payment. But there is no guarantee that the money will distribute, or the company will distribute money in any particular year. Excuse me. And quite frankly, there's no guarantee that they will ever distribute any money. There are companies that have never paid dividends. And so might ask yourself, what is it that the shareholders want? What are they valuing at that point? And the answer is that generally in the life cycle of a company, at some point they run out of great things to continue to invest their money in, and they start giving the money back. And so somewhere down the road, the investors expect to start getting these dividends. If the company makes a good financial decision and that creates more money inside the company, either to reinvest or to give to shareholders, then that makes shareholders happy, and the equity value goes up, and more people want the stock. Now, if the company makes bad decisions, the amount of money in the company goes down, and at some point it may not even have that much money, and the company may decide to shut down. When you shut down, they do what's called a liquidation. And in a liquidation, you basically gather together all the assets in the businesses and you sell them off and turn them into cash. You take the cash that's left that you raise, you first use that to pay off all of your debt. So that's what we call a preference, that the debt holders have a preference. And if there's any left, then that goes to shareholders or equity holders. And so that's what we call a residual interest, meaning that they don't get paid until the debt holders get paid. And what they get paid is whatever's left over, so the residual. Now, if rather than the firm making the decision to liquidate, they either default on their debts or file for bankruptcy or become insolvent, then the debt holders actually take control of the company, and you as an equity holder are no longer the owner of the company. You're no longer the group that gets to pick the managers of the company and tell the managers what to do. And in that case, the debt holders can do what they want with the company, just understanding that if at some point they decide to liquidate the company and it results in more value than is owed to the debt holders, then the rest of that value has to go back to the equity holders still. So they still have that residual right. So when we talk about equity holders, what is it that makes you an equity holder? Well, you have equity in a company if you own common stock in the company. And so common stock is a contract between a firm and an individual or an investor, whereby the firm agrees that the investor will receive a portion of any payments made by the firm to equity investors, really to common stock investors. And so it simply is a piece of paper that says if we distribute money to common shareholders, common stockholders, then you'll get your share, and it will kind of state what that means in terms of share. The contract may also give you voting rights on certain things, and so as an equity investor, oftentimes you get to vote on the board of directors for the company. And if you're a board of director, you get to vote on the management of the company. You get to decide who the CEO is. You get to decide vote on the strategies and what you think the company should be focused on. You might even vote on whether or not the company pays a dividend or not. So there are things that voters get to vote on, or that common stockholders get to vote on typically, but usually it's not a situation where every time something sort of management related comes up that they get all the stockholders together to vote. Usually the stockholders elect a board of directors, a smaller number of people, and then they rely on those people's vote to decide what to do. So again, the company creates stock by creating this contract that says that we will pay, that in the future, if we make payments, that you'll be entitled to a share of them. And the contract may say that you have voting rights, and if so, what those are, and so forth. And then they may have a collection of these contracts, which is called a stock issue, where they basically create multiple, possibly hundreds, thousands, even millions of these shares of common stock, and they put them out into the market, and that means that they're issued, they are out there, they are made available for sale. Now an investor can purchase the shares from the company directly, and there's no rule about how much the investor must pay. The company puts them out available in hopes that people are willing to pay a certain amount for them, but people may not. And of course the company at some point can pull the stock back and say, well, we're not going to sell it unless we can get at least X amount of money. But they can't force an investor to pay some amount. Now this is just like with the debt. This is called a primary market transaction because the transaction is between the company and that initial shareholder, and the money that the shareholder pays goes directly to the company. Now once the shareholder owns that stock, in some cases, not in all, they may have permission to sell that stock. In small companies, sometimes there's a restriction on your ability to sell the stock. You may have to get permission or only be able to sell it to certain people. With larger companies, usually that stock becomes what's called a listed security, and so it is available for sale to whomever wants to buy it in public. So it's a public offering, and it's just a question of the two of you exchanging the value. Somebody gives money, the other gives the stock. And so anytime that the transaction is between one person and another, and the company is not involved in the transaction, doesn't make any money or pay any money for the stock. That's called a secondary market transaction. And so, most of what you might be most familiar with in terms of stock and buying and selling stock is probably secondary market transactions. When a firm does a primary market transaction, that is called a public offering, usually, if it's for public stock, and you're buying it directly from the company. Now, what about the value of the stock? Theoretically, the value of the stock, well, first of all, the value is whatever a buyer and a seller agree. But theoretically, it should somehow relate to the expected value of all the current and future amounts that will be in the owner's equity account. And so from a book value standpoint, it's sort of saying, look, whatever money goes into that account becomes money that's available, to distribute to shareholders. And so that's the thing that we got a share of. And so that's what we are expecting to value the company on. More simply, in our projects, we have calculated something we call the future free cash flow to equity. And so if you remember, you calculated in your pro formas these free cash flows to equity. And so if we just took the present value of all those free cash flows to equity, that would be the value, the theoretical value of the company, or of the equity in the company, sorry. And so if we kind of turn that on its side, then we can get to what must be the cost of the equity to us when we issue it. And so we know the current market price, so think of it as we know how much somebody's willing to pay, and that could be me as an investor, that could be somebody else buying shares of stock, whatever that is. But we know what somebody's willing to pay as the current market price. We know what the expected future cash flows are, what we believe them to be, maybe what we've shared with that investor and kind of come to agreement on. And so if we know those two things, we can just solve for the discount rate that equates the future cash flow stream to this present value. And so that discount rate that we solve for would be the cost of equity. Okay. However, if we know the current market price and don't know the expected future cash flows, then we can't solve for the cost of equity. And so, kind of setting up, we're going to have two scenarios that we're going to look at. One is you with your specific project where you have built out and have some idea of what those free cash flows to equity are. And then think of just a company that you might want to buy stock in. And the fact that neither you, honestly, they may not even have a forecast of free cash flows to equity going out very far. They certainly aren't going to share it with you. And so you can't use the same approach here for that. So the first thing we're going to do, though, is we're going to talk about an approach that you can use to estimate cost of equity whenever you do know sort of the expected future free cash flows to equity. And then we're going to talk about an approach when you don't know that. All right? So I'm going to stop this video here. This will be sort of the short intro, and then the next one we'll pick up with video B, which will talk about cost of equity when you do know the expected future free cash flows to equity.